Home equity loans. So what are they? A home equity loan is where you're able to take out some of the equity that is in your property and be able to use that for certain purposes. You do have to tell some of the banks what your purposes are, and different lenders have different criteria. So let me explain. So you want to buy an investment property, but you haven't saved a deposit for an investment property. You are allowed to take some of the equity out of your own property that you're living in, using that as a deposit, a new investment loan on the new property. You can use it for if you want to refinance some of your debt. You want to do some renovations to add more equity to your property, but it has to be, the banks like to know what you're using the equity for, because they want to make sure that you're not getting yourself into a bad situation. I will cover the eligibility for those later on, but I just wanted to explain to you a little bit more about equity loans. A lot of people might know them as releasing your equity, refinancing your property, lots of different things. Now, what are some of the criteria when it comes to lenders, when it comes to a home equity loan? Now, a home equity loan might mean you have a property over here, you're living in this property, and this property is worth $700,000, the latest valuation, or $1 million, or whatever the case might be. The loan that you have on the property might be $400,000 or even less, at $350,000. So you paid down half the amount of what the property. You might have originally bought this property for $450,000. You might have only paid off $100,000 off the loan over the last several years, and you might only have a loan of $350,000. The price of properties have gone up. Now the properties might be worth $800,000. So what they call this is a loan to value ratio. So your loan is this much, the value of the property is that much, and there's a ratio. So that means there's about 60% that you owe on the property. So there's about 40% there of equity. That 40%, we can tap into that to use that. Now, the banks will only let you borrow up to 80% of the borrow. So say if the valuation is 100%, you're only allowed to take up to 80% of that. There are a few other eligibilities that come into play there. Many years ago, people could able to take out some of their equity. They couldn't verify the income. They didn't have to worry about any of those things, and it got a lot of people into hot water. And now today with compliance, that is not the case. So there are lots of different things that you could use your equity for. Majority of people use it to buy an investment property. So, and it's a great way to build wealth by doing so. Also, someone else is paying off that you might want to do that for your retirement, to looking at buying an investment property and getting someone else to pay off the loan and pay off that asset for you. It's definitely an asset, well and truly. So there are a lot of things that you need to take into account also, to make sure that you're not going to get yourself into a worse position. The other things might be you have some debt. You've got you want to inject some money into a business. You actually want to start a business, and you've got a solid business plan, and you want to take out $50,000 to be able to start up a business. So that's another reason you might want to take out some of the equity and turn that into making more income. Now, the eligibility for doing so, one is you have to make sure there is enough equity in your property to do so. The other thing is when you originally got your loan, we have to make sure that you're servicing it as well, because you might have got that loan and both of you were full-time employed. You might have only had 2 children. Since then, you might have 3 children. One of you might only be working casual part-time. One of you now might are self-employed and don't work anymore. So those things do come into account. We do really have to look at your servicing. We have to look at where your income is now, and if you're able to do that. It's not saying that you can't, it just works out what your servicing is. You might only be able to borrow a smaller amount or to cash out a small amount than a larger amount. The other thing is we have to check your credit report. Now, you are eligible to get a free credit report every year that are free for you to be able to get and to see where you stand. So people do get a little bit of a rude shock sometimes, and it could only be like an electricity bill, and particularly phone carriers like Telstra, Optus and things like that. They are notorious for not lifting things off your credit report. So it's a good idea to double check that every year. It's just like when like the beginning of the year, you want to check things. Credit report is a really good one to do. So those are the three main criteria that we need to cover to make sure that you are eligible for to be able to take equity out, to be able to create more wealth by an investment property, inject into a business, or pay out some debt consolidation or add renovation for more equity. Also, you can, if you do have an investment property and there's equity there, that's another way where you could take some money out of that property and buy another property. That's how people do end up creating wealth, by buying certain amount of properties. Anyway, it's a 15-minute chat. All we have to do is reach out to me. We just can have a discovery call, see where you stand, see if you're eligible, and see if we're able to do something and be able to use your equity in a really positive way. All right, no worries. Carrie Ann Simpson, local mortgage broker here in Caloundra, Sunshine Coast. I can do anyone in Australia. Remember, just reach out to me. A 15-minute call. Just give me a call. All right, see you later. Bye. I hope you found the information useful. Please subscribe to the channel and help me grow so that I can give more educational material for you in the future. Okay, we'll see you soon, or give us a call if you need to.